Imagine two neighbors, same street, same house price, same income. One of them spends the next 15 years aggressively paying down their mortgage. The other invests that extra money instead. At the end of 15 years, the first neighbor owns their home free and clear. No debt, no payment, pure peace of mind. The second neighbor still has a mortgage. But they're also sitting on roughly $400,000 more in investable assets. That's not a trick. That's arithmetic. And understanding why it works and when it doesn't is one of the most important financial mechanics most people never actually run. The conventional wisdom is almost universal. Pay off debt. Get rid of it. Debt is a burden, a risk, a weight around your neck. And for a lot of debt, high-interest credit cards, personal loans, predatory financing, that advice is completely right. Those instruments are designed to transfer wealth from the borrower to the lender, slowly and permanently, and eliminating them is correct gameplay. But a mortgage is a different kind of instrument. It's not a trap, it's a lever. And the question isn't whether to pay it off as fast as possible. The question is, what's the actual cost of this debt, and what else could that capital be doing? When you conflate all debt into a single category and apply the same rule to all of it, you're not being prudent. You're ignoring the underlying system architecture, and that costs people real money. Here's the core mechanic. When you take out a mortgage, you're borrowing money at a fixed interest rate. Right now, in 2026, a 30-year fixed mortgage runs around 6.5%. That's your cost. That's what you pay to access the capital. But here's what the pay-it-off instinct misses. That rate doesn't exist in a vacuum. It exists in a financial ecosystem where other assets are also generating returns. And the question you should actually be asking is whether your money earns more working somewhere else than it costs you to keep it borrowed. The S&P 500, over the last 100 years, has returned an average of roughly 10% annually. Over the last 30 years, that figure holds close to 10.4%. Those aren't projections. That's historical performance data, and it creates a spread. If your mortgage costs you 6.5% and an index fund historically returns 10%, the math suggests you're generating 3.5 cents on every dollar you don't throw at the mortgage. That's the arbitrage. Not glamorous, not complex, just the difference between two rates. Now, the pushback you're already formulating. What about risk? The 10% isn't guaranteed. The 6.5% is. You could pay down the mortgage and get a certain return of 6.5%, risk-free, and that's a legitimate point. But it's incomplete, because it only accounts for the interest rate and ignores everything else that actually governs the decision. Let's slow down and look at the actual variables. First, the mortgage interest deduction. Depending on your income and how you file taxes, a portion of your mortgage interest may be deductible. That doesn't erase the cost, but it reduces the effective rate. A 6.5% mortgage, after accounting for tax treatment at a mid-range income bracket, might have an effective cost closer to 5% or below. Your actual hurdle rate, the return you need to beat to make investing smarter, just dropped. Second, inflation. This is where mortgage debt becomes structurally interesting. A fixed-rate mortgage is denominated in today's dollars. You borrow a fixed nominal amount and pay it back in future dollars that are worth less. Inflation at 2 to 3% annually quietly erodes the real cost of your debt over time. The bank doesn't adjust your payment for inflation. You're paying $2,026 now and $2,040 later, and those are not the same. Fixed-rate mortgage debt is one of the rare liabilities that gets cheaper in real terms just by existing. Put a number on it. A $2,000 monthly mortgage payment today, with 3% annual inflation, has the real purchasing power of roughly $1,300 by the time you're 15 years into the loan. Your payment didn't change. Your income, assuming it tracked inflation at all, went up. The debt quietly got lighter while you weren't looking. This is why economists talk about inflation as a borrower's friend and a lender's quiet tax. The bank locked in your rate. Inflation does the rest. It's a passive mechanism most people never account for, and it systematically tilts the long-run cost of fixed-rate debt lower than the nominal rate on your document suggests. Third, liquidity. Extra mortgage payments are illiquid. You can't access them when you need them without refinancing or selling. Money invested in a brokerage account isn't perfectly liquid either. There's tax drag on gains, but it's considerably more accessible than equity locked inside a home. In a world where income disruption is increasingly common, holding liquid assets has structural value that doesn't show up in a simple interest rate comparison. Put those three factors together: tax treatment, inflation erosion, and liquidity premium, and the true cost of mortgage debt is often significantly lower than the nominal rate printed on your loan documents. Which means the spread between debt cost and investment return may be even wider than it first appears. This is where the math starts to feel uncomfortable, because it runs directly counter to the emotional logic most people operate on. There's a deep psychological satisfaction in eliminating debt. It's concrete, it's visible. Your balance goes down, your net worth technically improves, and you feel less exposed. That's real. That's not irrational. Financial stress is a genuine cost, and reducing it has value that doesn't show up in a spreadsheet. If carrying mortgage debt keeps you awake at night, the emotional cost of that anxiety may legitimately outweigh the mathematical arbitrage. Psychology isn't separate from personal finance. It's part of the system, but we should be clear-eyed about what's actually happening when someone chooses the emotional comfort route. They're paying a premium for peace of mind. That premium is real, it has a price, and they should know what it is before they decide it's worth paying. Think of it in resource allocation terms. You have a fixed amount of capital each month beyond basic expenses. Every dollar you allocate has exactly one primary job, and you're choosing between paying down a 6.5% debt or deploying it at an expected 10% return. That's not a trick question. It's a resource management problem with a fairly clear optimal answer in a static model, and that answer shifts based on your specific rate environment, time horizon, and risk tolerance. But it doesn't disappear just because the answer feels counterintuitive. Now here's where historical context matters enormously. From 2009 to early 2022, 30-year mortgage rates sat in a range that hit a floor of 2.65% in January 2021. People who locked in mortgages at 3% during that window are in a radically different position than someone who took out a loan at 7% in 2023. The math isn't just different, it's almost incomparable. A 3% mortgage versus a 10% historical equity return gives you a 7 percentage point spread. That's not an argument for investing instead of paying off debt. That's basically a structural gift from the rate environment, and treating it like regular debt psychology was one of the costliest financial mistakes of the post-pandemic era. Millions of people refinanced into historically cheap fixed-rate debt, then rushed to pay it down faster because debt felt dangerous, while the market compounded at double-digit returns. On the other end, someone with a mortgage at 7.5 or 8% faces a much tighter spread, higher volatility risk relative to potential returns, and a genuinely closer decision. The invest instead strategy isn't a universal law. It's a rate-dependent optimization. Context isn't a footnote. It's the entire calculation. And let's be direct about where the conventional wisdom comes from. The always pay off debt framework is appropriate for the median borrower managing multiple debt obligations, behavioral tendencies toward overspending, and limited financial literacy. It's a useful heuristic, a simplification designed to prevent worse outcomes. Heuristics exist because systems are complex and rules of thumb reduce errors in aggregate. But heuristics are not strategies, they're defaults. And the people who apply defaults without examining the underlying mechanics aren't optimizing. They're accepting someone else's approximation of their situation. The actual question is not, should I pay off debt or invest? The actual question is, what is my after-tax effective cost of debt? What is my realistic expected return on deployed capital adjusted for my risk tolerance and time horizon? And given those two numbers, where does an additional dollar generate more long-run value? That's the calculation. Run it with your actual numbers. The answer won't always be invest, but it won't always be pay off the mortgage either. Let's go back to those two neighbors. Same house. A $320,000 mortgage after the down payment, 6.5%, 30-year fixed, monthly payment just over $2,000. Neighbor 1 finds an extra $500 a month and throws it at the principal, every month for 15 years. The result? They pay off the loan almost a decade early and save roughly $140,000 in interest. That's real. That's not nothing. Neighbor 2 takes that same $500 a month and puts it in a broad index fund. Doesn't touch it. 15 years later, at a historically average 10% annual return, that account holds somewhere in the neighborhood of $200,000 and climbing. They still have a mortgage. They also have an asset that belongs entirely to them, is liquid, and is continuing to compound. The neighbor who paid down the mortgage saved $140,000 in interest. The neighbor who invested has $200,000 in assets, and the spread between those two numbers is still growing. Neither decision was irrational, but they aren't equivalent. The math has a direction. If you find yourself genuinely thinking through questions like this, not the surface-level rules, but the actual mechanics underneath them, then you already know why this channel exists. 8-Bit Economics publishes every week, and every video is exactly this. Financial systems stripped down to the underlying code. Not predictions, not hype, not portfolio recommendations, just how the machine actually works, so you can make better decisions with your own capital. If today's breakdown shifted something in how you think about debt, hit subscribe and like the video. It genuinely helps the algorithm surface this to people who think the same way. And drop a comment with where you land on this. Whether the rate environment you're in changes the calculation for you, or whether the psychological premium is worth paying. That's the actual debate. By the time everyone sees it coming, the smart play is already over. So here's the real reason this matters right now. We're sitting at mortgage rates around 6.5%. That's not catastrophic, it's not a crisis, but it's also not the 3% world that defined a decade of personal finance decisions. The spread between mortgage debt cost and equity returns is tighter than it was 3 years ago, which means the calculus is genuinely closer, which means the blanket advice, in either direction, is less reliable than ever. You're not in a world where the answer is obvious. You're in a world where running the actual math, with your actual numbers, with your actual tax situation and your actual time horizon, is the only approach that isn't just borrowing someone else's approximation. The rule is a shortcut. The math is the answer. And those are not the same thing.